In fact, it's interesting, Santosh, the points that you're making. And, because if we see the small cap index is, say, 250 companies.
Yeah.
And if one looks at the universe of small cap, I mean, even if we exclude half of that universe, we are still talking 2,500 odd companies. And therefore, as you rightly said, in that category, the index may not necessarily reflect. And that is where the role of active fund managers like you comes in, where you are actually looking beyond those 250, including those, but also looking beyond to see how you can pick stocks, which may not be the case with large cap because, you have a 100 stock universe and 50 are anyway part of the index. So my next question to you is that, you did talk about how you pick a company, but how do you manage the risk? And if I may add one more point, it is that what I heard you, which I found really interesting, is that, and in fact, you do it in both your funds, isn't it? Whether you look at balanced advantage or multi-asset, is asset allocation. And you talked about how you maintained the allocation at 30 and adjusted the portfolio depending on the way prices moved. And that is actually what all the pundits say about the market pundits, about how asset allocation is so important. So if you could touch upon these two issues for me, please.
See, so I'd come to the risk part first, because I think that's where a lot of people have concerns when when you see some small caps or anything like that, right? So I'll come to the risk management part first. Okay, so see, to me, firstly, I'll go back a little bit to your last question and then come back to this part, because you pointed out that actually most of the market participants do it in large cap because that's supposed to be lesser beta. The way we actually, this is one thing which I've seen, that everyone talks about risk from a beta point of view, standard deviation point of view, right? That standard deviation is the only way to measure beta, only way to measure risk, right? But standard deviation is all about where you moved up or down. Eventually, where you go from there, it doesn't capture that. The company can die also. So that is also a risk. It's not that a company has fallen 20% and again come back 20%. So 20% downfall is a risk and 50% uptrend is not a risk. So thing is, that's how we measure. Standard deviation is one of the key measures how you're looking at the risk part. And that's why a lot of people do large caps. My view is that, see, I have that the fund mandate is that equity is flexi cap. And if equity is flexi cap, then my view, I'm not doing a great justice by being very passive on the equity allocation and only managing the only managing the returns through asset allocation. My job is threefold. My job is, at the first instance, asset allocation, second instance, within equity sector allocation, and third instance, within the sectors, the stock allocation. And for me, all three are active. We play every part of it active, because I think this is the mandate, because eventually the customers who have given you money, they want returns, right? And they are paying for it. So they're not paying you for running a passive equity fund, an active asset allocation fund. I don't think they're running. They're paying you to run an active asset allocation and an active equity allocation, right? This is what they're paying for. So they should get what they're paying for. So this is my view. Maybe everyone has a view, and their views can be different. So that's first part.
Sure.
Now, if I look at the asset allocation part, the way we manage it, as I told you, we have a proprietary index called Motilal, right? So that is a quant model which we have actually devised, and it works very beautifully. It takes into account the price to book, price to earning, and dividend yield, and based on that, it comes out with the right equity allocation at that point of view. Now, what we do is, now with the flexibility, we overlay it with the current, the sort of, because it's all backward looking, right? Because all this data is backward looking. You can't have a forward looking price to book, price to earning, because it won't be right. So this data is backward looking. Now, what we overlay it with, that if there is an earning momentum, then the stock market is going to do well despite being expensive. So we overlay it with earning momentum. We overlay it with the current geopolitics. And then we decide what should be the right asset allocation. In most of the scenarios, it's quite closer to what movie is saying. But tactically, for a month or two, when we find that the geopolitics or the market momentum is very strong, we might differ from where the movie is. So movie is the key determinant on how we decide on the asset allocation between equity and other asset classes. Now, other asset classes, how we will do it is based on our view on those asset classes. But between equity and other asset classes, this is how we are doing it. Now, so that's the allocation part. Second is the risk management part. See, as I said, that we are managing what we do is that at multiple levels, right? The first level is the volatility of your portfolio. At the portfolio volatility level, we always monitor what is the portfolio volatility or what is the beta of my portfolio. And you will find that whatever might be the composition of the portfolio, in no time our beta of the portfolio is exceeded above 1. We have kept the beta below 1 for whatever time period we want. So that what we are clear is that, see, and beta doesn't work daily actually. With the outcomes, if you look at on a 3-month, 6-month basis, it gives you what the beta is supposed to do. But daily basis, it might have a different outcome. But what we make sure is this is the first part, what we try to do. Second, so that's one. Second is the liquidity risk. We actually take that into account quite clearly, that how much because small cap, when you deal with small caps, liquidity is the biggest risk. I don't think it's unless and until you get into, because you're talking about 5,000 companies, there will be 2,000 of those which are not really good companies. So unless and until you have you are able to find out the right, if you are able to find out the right company, the only risk you are left out with is the liquidity. Right? And so we have actually, last year was an acid test of the fund in managing the liquidity risk, because we had outflows and because of our past experience, we had outflows last year, and we actually were able to manage it without any problems. Right. So liquidity is one risk we manage very clearly. At any point in time, my portfolio, a majority of it can get liquidated in a very short period of time. So that's another part which we quite clearly see. And then the other parts of the risk that see, we have a very good risk management policy in place, and then at all point time we are looking at our exposure limits. Given the fund is small, exposure limits actually don't matter as of today, because whatever we might buy, our exposure limits are way above that, but because the size of the fund, and that's why we are able to take some chunky exposures as well. So we are always looking at the exposure limits. And see, the biggest risk to me comes from the governance framework of those companies, and that's a no-no area to me. So what we never get into that part. Whatever might be the price I get, because I come from insurance background. My first job was an underwriter and a claims person, and we were taught only one thing, that okay, every risk you can take, don't take moral hazard risk, because even if you charge 100 rupee premium for a 100 rupee risk, you will lose money. So if you are getting in the stock market, if something at 1p also, and you think there is 5 times upside, don't buy it if you think there is a governance problem there. So that risk we avoid at the first place. So that this is one part. And
how you go about it. Yeah.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.